I'm Simon Russell from Behavioural Finance Australia, and today I'm joined by Craig Sankey from IFS. Welcome, Craig.
G'day, Simon. Hope you're well.
Yes, very good. Thank you. So today's conversation is about risk profiling. Why risk profiling? Well, clearly it's a very important part of an investment advice process, an advice process around superannuation investment choice in particular. But it's not without controversy. So what's the right tools that we should be using when we're profiling clients? If we drill into it, which questions should we ask? What words should we use in those questions? How should we frame choices? How can we interpret responses from clients? How do we combine all this stuff into a risk profile? So particularly if there's inconsistent responses. And then once we've got a risk profile, what do we then do with it? How do we reconcile it with the client's objectives? And in all of this sort of stuff, what's the role of the advisor? So is the advisor there to educate and help the client through the process? But does this perhaps bring in some subjectivity into the process as well? Now, why it's particularly pertinent for Craig, and hopefully we can explore this in the conversation, is that IFS has just been through a process where they've explored a lot of these sort of issues of going through, looking at your existing IFS's existing risk profiling tool and encountering a lot of these sorts of issues. So over the next hour or so, I'm going to ask Craig, I guess, to reflect on some of those experiences across that journey, and so I guess share with us some of the insights and where they landed. So hopefully this conversation is useful for people who are involved in financial advice, who perhaps use or design risk profiling tools, particularly those people involved in the large superannuation funds and the sort of the investment choices that they're helping members make there. Now, of course, we're not excluding anyone from watching this video or listening to the podcast version, but if you are an individual investor, please be aware that the conversation here is general in nature. We haven't considered your individual financial circumstances or needs, so this is not intended to be personal financial advice. But with all that said, perhaps, Craig, if you don't mind kicking us off with perhaps just a quick blurb about IFS and your role there, if you don't mind.
Yeah, thanks for all that, Simon. So we're Industry Fund Services. So we're owned by a group of industry super funds or profit-to-member funds, and we provide licensee services to a number of those funds. So some of our owners are our clients and some of our clients are our owners, but there are differences there. Not all of our clients are our owners. So predominantly what we do is we license financial advisors. We license around 125 financial advisors at the moment, and we also provide licensee services to other funds that may or may not use us for licensing. So power planning, compliance, audits, CPD training, all that type of thing. So that's predominantly what we do on our side of the business, but IFS also has an unpaid super arm as well. So that's the second part of the business. My role here at IFS is I look after the training, the CPD training of the advisors. Also look after the rule set, the guidance, the processes that the advisors have to follow when providing advice under our licence, as well as the advice governance side of things. And I get involved in a number of different projects. Risk profiling's one, and digital advice, which I think we're going to touch on as well, would be another one of the projects that we're looking after.
Fantastic. So if we jump straight into the risk profiling side, but perhaps you can take us back to day one and tell us what's the sort of the existing process that you take advisors through. What sort of questions, what experiences have you had with that?
Yes. So firstly, we've got 6 outcomes or 6 risk profiles that clients get put into. And a number of years ago now, well over 10 years ago, we hired an investment consulting firm to work out what those N6 risk profiles should be. So we kind of mapped them to risk measure bands, which a lot of super funds would be familiar with. So a client all their investment options for super funds have to be labelled. Label 1, 2, 3, 4, 5, or 6, and low risk, medium risk, low to medium, medium to high. So our 6 risk profiles match the first 6 risk bands of those risk labels. So hopefully we've got some consistency. Doesn't matter which super fund you're being put into, you're going to walk away with a very similar outcome. So that, I think, that's held up really well, and we were comfortable with that. So there was no need to change the end result. It was, how do we make sure we're getting someone into the right result in the first place? So our approach is probably very similar to what most financial advisors do currently. We've got a risk profile set that's 8 questions. Each question gets a score, and then at the end of those 8 questions, you add up the score, and you, depending on what number it is, you get placed into one of those 6 outcomes. So that has been our current approach for a long, long time, and probably the approach from what I see for most other licensees.
Yeah, can you give us a sense of some of the questions? What sort of things you'll be asking clients?
They'll be asking things about how comfortable they are with risk, their investment time frame, what kind of return they're looking to achieve, how, would they panic if they had a 10% negative return, that type of thing.
Yeah, okay. And we'll get into the data analytics, because I know you've done some great sort of work on the data side. But what anecdotally, what sort of feedback have you got from advisors who have used the tool, or possibly from clients who have come through that process?
So I think the wording of the questions is always a little bit subjective, and what we've found is some of the advisors have kind of put their own spin on it and asking it in a certain way, or framing the questions in a certain way. And from the client's point of view, it's a bit of a black box. So you go through these 8 questions, and then ta-da, here's your score, and this means X. And you could have been answering questions a little bit inconsistently in terms of, I want a great return, I don't want any risk. And then you might end up somewhere in the middle, which might not be appropriate. So it could be a little bit of a surprise by the time they get to the end, and they're given, well, this is your risk profile, how do you feel about that? Quite often, because they haven't been taken along the journey about this is where you're going to be ending up, there's still a little bit of confusion there.
Yeah, okay. And perhaps we can touch on the data analytics. So anecdotes, I guess, are one thing, but the data tells you a story that might be different from the anecdotes. And I know you've looked at quite a bit of the data that's come from the advisors. What did you find from that analysis?
Yeah, so we do give a lot of advice, because super funds see a lot of members. They've got a lot of members, and they have to give a lot of advice. So we give 3,000 or 4,000 pieces of personal advice a year, and the vast majority of those also include some kind of investment choice advice. So when we looked into the data, we had a look at where our clients ended up in out of the 6 risk profiles. And when you look at it at a big picture, it kind of made sense. There's a lot of clumping in the middle. A lot of the clients ended up in the middle kind of risk profiles. Nothing really stood out. Maybe some of our older clients came out a little bit more conservative, and the younger clients came out a little bit more aggressive. Again, probably nothing unusual or surprising, and probably all good. It was just when we drilled down into the individual advisors levels that we found some anomalies of how some advisors' clients tended to end up in the same risk profile, which just kind of begged the question, were those advisors explaining concepts, themes, and framing questions in a certain way?
Yeah, do you have some examples that you can share with us from your data analytics?
Yes, yeah. Let me bring up a couple of slides.
Yep.
So this is basically at IFS. We've got a couple of different advisor levels. One of them we call comprehensive, which basically means that they've got a wide variety of what they can provide advice over. So we wanted to compare apples with apples as much as possible. So these advisors roughly see the same types of clients is really what I'm getting at. So we're not choosing different levels of advisors that are seeing different kinds of clients. So as I said, we've got 6 risk profiles, but in this first example, what we're looking at is risk profile 3 versus risk profile 4. So on the left-hand side, what percentage of clients was put into risk profile 3? Now, our average across the whole licensee for these types of advisors is around 46%, whereas in this example, advisor A, 83% of their clients, so more than 8 in 10, were put into the 1 risk profile, which we found quite surprising, that so many clients would end up in the 1 risk profile. Compared that to advisor C, they had over 7 out of 10 going into risk profile 4, so the next one up the spectrum. So it's a as you can see, quite a huge difference. 83% for risk profile 3, and advisor C only had 13%, whereas advisor C's kind of doubled the average for risk profile 4. So something was going on there. As I said, they're seeing roughly the same kind of client. They're roughly the same age, and this is over hundreds and hundreds of examples. This is not advisors that have seen 5 clients. They see a lot of clients year on year.
And do you have a
And then,
theory about what's going on there?
I think it is the way that they're asking the question and framing the question and explaining the question, because our current risk profile set does rely on the advisor explaining concepts and educating the clients along the way. We've got some guidance that helps the advisors explain what we're trying to mean by each of our questions, but there's no doubt that the advisors explain it in their own way, and I'm assuming they explain things very similar to each client that they see. So we suspect that these advisors are explaining these concepts, and maybe it's only slightly different ways, but they're definitely influencing the client and their results. And look, most advisors do agree that they can and sometimes do influence the clients in their scoring of their risk profile.
Yeah, I might just relay a couple of sort of concepts from, I guess, from the psychology literature that that this sort of result sort of triggers for me. So see what you think and how relevant you think these are. But one, I guess, is that we're looking at adjacent risk profiles here. And from what you've described, you've got a series of questions that leads a client to being in category 3, risk profile 3, or slightly different answers possibly that end up in category 4. But those clients, I don't think, correct me if I'm wrong, don't get to the point of at the end going, well, I'm in 3, but let me compare myself, or compare what does 4 look like. All those advisor A clients, 83% in category 3, did they get a choice to go, well, you know what, you could have got a slightly higher return over here, but for a slightly higher risk? Would you have? Does that actually sound more appropriate for you and your needs? So that's not part of the current process, is it?
No, not really. I think it's this is where you ended up with. Here's a summary of that. Does that sound okay with you? It's almost when the advisor says, does that sound okay with you? It's almost leading them to say, well, everything appears okay. This is what your result in it, and they're kind of giving it an endorsement, also, almost to say, yeah, well, this is what you scored, and this is what you ended up with, and this all sounds good to me. Any problems?
Yeah, but it doesn't have the aspect of comparison. So I guess we know that. I mean, it's not always the case, but often the case that if you give people a point of comparison and say, well, how does this one compare with this one, and lay it out in front of them with a bit like when you're buying an airline ticket. Here's the one with no frills. It's cheap. You don't get any leg room, and you won't have any luggage to take with you, for example. But you can go through and choose. That point of comparison allows people to, I guess, trigger a different way of thinking. But that's perhaps absent from this version, but maybe is something that you've picked up subsequently.
Yeah, no, absolutely. Yeah, no, that's correct. We don't currently do that. And I'll just show the second example, Simon. So this time, if we just split the risk profiles down the middle, so 1 to 3 being our most conservative and 4 to 6 being our most aggressive. And I've kept advisor C here, and I've just brought in advisor B, although advisor A would have had a very similar result. In this example, advisor B, 93.75% of their clients came out in the most 3 conservative risk profiles. When you compare that to advisor C, only 14%. So conversely, obviously, nearly 86% of advisor C's clients came out 4, 5, or 6. So the 3 most aggressive. Again, that's double what the average is. So seeing the same types of clients, roughly the same age, and getting hugely different results there as well.
Yeah, so this isn't a individual bucket, but a broad skew, if you like, or a bias up or down in the spectrum. And again, do you have theories as to what's causing that?
Yeah, unfortunately, we we would have been good to be able to risk profile our advisors, and it wasn't possible for a number of reasons, which I won't get into here. But I do have the feeling that further to what we said earlier about the advisors influencing the client and framing the questions in certain ways, that they might have their own biases, and some advisors are more conservative than others, and some are more aggressive than others. And I've heard advisors say, oh, the best long-term return is always to go in growth assets. That's what everyone should be doing, and that's their bias. And financially, they might be right, but it doesn't always relate to someone's risk profile, though. So I get a feeling that they're kind of putting their bias on these end results.
Yeah, and that would align. I mean, there's a large scale study out of Canada where they had, I think from memory, thousands of advisors and tens or possibly hundreds of thousands of clients, and they did have data like the advisor's risk profile and own personal investments, because it was, I think, all through the same platform. And then there was a very strong correlation between an individual client, the other clients from that advisor, and the advisor's risk profile and investments. So it did look like the advisor was perhaps projecting their own risk profile onto their clients. And you might say, but maybe that advisor is just attracting clients that are like them, which maybe that was the case. But once a client moved from one advisor to the next, well, actually, then they started looking like that new advisor's clients, and that advisor as well. So it does look like, whether it's inadvertent or deliberate, some level of sort of, I guess, pushing but influencing in some way the advisor.
Influencing, I think, would be the right term. And look, just to add to that, Simon, there most of our advisors don't have ongoing clients, so they're not attracting specific clients. They work for industry super funds, and they're given the clients to see, so they're not attracting any particular client. They're all roughly ending up with a random set of clients.
Yeah, I think another thing that comes out of that analysis, which is perhaps hidden from a lot of the thinking, I think, around risk profiling, which is that in aggregate, the tool might look fine, which I think is what you said. You look, it's some sort of normal distribution. Most people are in the middle somewhere, and it looks better for the higher risk. Younger clients are slightly higher. All that makes sense. But I mean, people like Daniel Kahneman, the Nobel Prize winner, his most recent book is all about noise, is focusing on the fact that there's a lot of focus on bias, which we've seen from some of your results as well. But really, we should be focusing on the inconsistency, the noise in these processes, which, if we have a process that's not sufficiently, I guess, robust, all of those subjective or sort of, I guess, individual sort of nuances of the advisor and how they happen to position or explain a term or interpret a result can lead to quite sort of strange individual results.
Absolutely. Yeah, no, that's my intuition as well. That I've sat in on a few interviews, and the way, again, it's the same question set. We give the same guidance to all the advisors, but the way they explain the question, or the way they explain a member's question is quite different, and that relates to different answers from the member.
Sure. So the data analytics makes it look like maybe there's some things that could be improved. Doesn't look like a disaster, but it does look like some improvement might be possible. Was there anything else sort of going through your mind as you were thinking about the need to review and update the risk profiling tool?
Look, there was. As I said, we give thousands of personal advice over this topic each year, and another group of advisors that we license we call them limited licensed advisors. Sometimes they might just have an appointment just to give which investment option should I be in. And it sounds like, if you're a member and you ring up your super fund and say, look, which investment option should I be in? It sounds like a pretty simple question. Yet our current process takes, on average, 1 hour. 1 hour once you actually get in front of an advisor to go through the questions, have the backwards and forwards, give the education, and takes an hour to get an answer. Now, speaking to members, they just can't believe they can't believe it. They think it might be a 10-minute thing, and then they go, "Well, I don't have an hour. Just tell me which investment option I should be in." So, another one was, So can we make it a bit more efficient? How can we make the whole process efficient, not just for the member, but for the advisor as well? Because the advisor is explaining the same concepts every time. So. Any advisor's an expensive resource. Do you want them sitting there explaining 10, 15 minutes up front of every meeting what risk and return is, why compounding is important, all these are concepts that are very, very important to know, and members really need to know before they can make a good choice. But does that have to be explained manually every single time as well? So that was another thing we thought. And look, I don't know if I kind of emphasised it enough, but another reason why we kind of started this whole process was digital advice. We're looking to license some digital advice tools, and our current process does rely heavily on an advisor explaining concepts. So if an advisor wasn't there, we're not confident that our current risk profile set would give a good outcome at the end, because the client just really wouldn't know how to answer some of those questions without some support. So that was the last kind of thing we thought about, and the thing that's kind of driven this whole process urgently is we need a process that can stand up by itself without having to have an advisor involved every single time. So they were the things that we were kind of looking at, and then that kind of started us on our journey about what we should be doing going forward.
Yeah, okay. And presumably you're not the first group of sort of advice-related professionals who have thought about improving their risk profiling tools. So others have been down this track in the past, and there are sort of third-party tools out there. So when you looked around at what was available, what were your impressions, and how did you sort of think about whether they might be appropriate for what you needed?
Yeah, so we did have a look around the market to see what was there, and we wanted it to be able to use for both case scenarios. One, to be for an advisor to be able to use with a member, but also for it to be able to be a standalone and digitally used as well. So it had to work in both those settings. And when we had a look around, what we found was there was a lot of risk profiles, question sets similar to what we already had. The whole 8 to 10 questions or even more, and explaining concepts that might be difficult to understand. And we also found risk and return being separated. And when you're going through digital advice, if there's an advisor there, you might be able to pick them up and say, well, you can't, maybe you haven't understood this concept. You can't say you don't want any risk, you want a really high return. Whereas the digital advice tool might let them go through. So you can't have those kind of questions separated. There has to be a trade-off. So there was still a lot of those questions about that didn't resonate with us, that didn't make sense. And there was a lot of jargon and mathematical concepts that, again, we didn't feel suited our member base. We don't tend to deal with too many high net worth clients, or maybe really highly financial literate clients. In a lot of instances, we deal with everyday super members, mum and dad members that need to be explained things in clear language. So we found quite a few issues when we went and had a look, and nothing that really thought, yep, that's going to suit us.
Yeah, okay. So you've started to allude there to some sort of issues with specific questions. Maybe we can sort of dig in, if you don't mind, to some, even down to the level of the specific words that are used on the page, if you don't mind, just so we can get a feel for what sort of issues you're encountering and why they might cause problems. Yeah.
So there was one question which maybe a lot of people are familiar with because it's from a well-known tool. It asks about what their willingness is to take financial risks, and it again, so it separates risk and return, and then it asks what kind of risk taker they are. So you can have extremely low, very low, low, average, high, very high, extremely high. So as I said, it doesn't ask about return; it just asks about risk, and it started off with compared to others. So compared to others, so I'm not sure compared to you, Simon, if I'm a big risk taker or not, because I don't know what your risk appetite is, and I'm not sure how the average super fund member knows how they are compared to others, whether they take more risk than others. They probably have no idea. And then that language about what's the difference between an extremely low and a very low and a low risk taker. So I just imagine that a lot of people would answer that question very differently. They might have very similar risk profiles, but the way that they interpret that question, that you could get really different kind of results.
Yeah, I think this is a great example because it links then back to the sort of inconsistency and the noise that has been added to a risk profiling question or a process. Now, of course, this isn't just the only question in their tool, presumably, so that they'll have other sources of information. But looking at this one, so I agree, when you ask people to compare themselves, the fantastic stereotypical example of this is when you ask people how they compare with others on driving ability. And of course, we're all, 80% of us or something are above average drivers, which is not to say that we all think that we're all above average at everything. So you've asked people about public speaking, for example, and we tend to think that we're below average public speakers. It's a similar sort of reason that you sort of reflect on your own aptitudes and feelings. It feels easy and comfortable for me to drive, therefore I must be above average. It feels difficult and uncomfortable and a bit anxiety provoking for me to be on stage in front of a large crowd, therefore I must be below average. But in both cases, we've failed to reflect adequately on what other people think and feel about in a similar situation. So I think we're sort of asking the member in those cases to do the hard job that we need to do, which is to compare them with others, and asking them to do it for us, which of course would be very difficult.
Very difficult, almost impossible. Yeah.
Yeah, I think so. I mean, in your case, you'd probably be in the best position when you're comparing with me. At least you've looked at the data. But we can't obviously anticipate the members will have done the same there as well. And you also mentioned the low and the very low, for example. So I think that's another great example, because there's a problem, as you pointed out, with jargon. So we don't want to put an IRR or some terminology they haven't heard in the question. I think most people sort of understand that that's problematic. But in this case, the words low and very low, they're in common usage, aren't they?
Yeah.
But the problem there, of course, and there's some good research around this, which is that they can be very different probabilistic sort of interpretations. So one of my favorite examples here was the word might. I know we've talked about this previously, but I mean, I might be late for a meeting versus I might win the lotto. The context there makes a big difference. So what I think of when you use that term might be quite different from what you intended. Mine might be late for the meeting, which might be 90%, and then might win the lotto, which is 0.001%. I could end up with very different interpretations. I think it's another example of sort of perhaps the inadvertent noise. Maybe this is not advisors deliberately biasing by influencing them into a bucket, but it's just the advisor's got a different interpretation from the client's got a different interpretation from the person who created the risk profiling tool, and hey presto, we end up with different answers.
Yeah, absolutely. And I can see a lot of people answering that question, as I said, very differently.
Yeah. Okay, that was a great example. What others did you come across?
Look, there was another example which was quite interesting. We found where there was you had to make a choice between losing money and gaining money, but they were linked. So there was an amount of money you could decide. Okay, well, I'm willing to risk this amount of money to make X amount of money, and that was quite interesting. Because it was an interactive kind of slider, so it would have worked really well digitally, and it had risk and return combined. So I thought it was quite interesting and a good way of looking at it. However, some of the numbers were quite they were a little bit abstract, and they were asking people to kind of weigh up the odds in terms of, is this a good bet or not a good bet? Because there's a number of different rounds, and the odds change depending on which round you're in. So it was almost, can these people, can your member, or can the person doing this risk profile, can they calculate the odds rationally, and are these amounts really meaningful to the person depending on what they had in their super balance as well? So,
did they have a choice? Conceptually. So could they? Sorry to interrupt. Could they put in? We know what I've got $50,000 in super, or I've got 500,000, and make the numbers appropriate for me, or was it just a set figure in that case?
It was just a set figure. Well, it was a set figure, but as you moved your slider, the amount that gained or lost would be up or down. So it didn't really matter what your starting balance was. It was. So you could have actually moved the slider, in theory, I suppose, to more than you actually had in your super fund. It wasn't directly linked to anyone's balance or anything like that.
So if I said I'm willing to lose $5,000, for example, to make 10, would you interpret that to mean I've got a high risk profile, or would you interpret that to mean, well, actually, Simon's got $500,000 in his super anyway, and so $5,000 is what he's up and down every day, so it doesn't really matter. How would you interpret the results there?
Yes, well, I think the results are supposed to be interpreted the former. It's relating directly to your risk profile in terms of you're willing to take on twice as much, to gain twice as much to lose half as much. That's the idea behind it. But as you said, those amounts might not be relevant. Someone with a very large balance, though they might be willing to take more risk because they've got a larger risk capacity, and those amounts don't mean as much to them. So that wasn't really considered by the tool. Yeah,
and did the tool, I guess, allow the user to think about the implications of say if it's a $50,000 loss, Does that mean I've got less money in retirement? Does that mean I've lost it next year out of my super? But to be honest, I'm not going to touch my super for 40 years, so it doesn't matter. Does that mean I can't pay the mortgage? Was there sort of a tangible connection between these numbers and the client's reality, or not?
Not really. No, there was they're all just in isolation. So there were kind of 6 different mathematical models, and yeah, the mathematical models were really designed to come up with your risk profile, how much risk you're willing to take, and that's really in kind of isolation to anything else.
It does sound a lot like actually what some of those old Nobel Prize winners have won Nobel Prizes for. So look at Daniel Kahneman and his partner in crime, Tversky, although he died before he would have won the Nobel Prize as well. But a lot of their work was in laboratory with these sorts of relatively abstract type of mathematical trade-offs, and that's how we've got things like loss aversion. But the question, I guess, has always been, well, how much are they relevant for different contextual circumstances outside of the laboratory setting of a relatively abstract question?
Yeah, so that was one of our concerns in terms of having those tools just kind of sitting there, and can someone really make a rational and also a judgment when maybe their emotions might be taking over when the markets are crashing, and how do they really know what they would do in that instance? Yeah.
Do you have another example?
Another example was from an online risk profile that we were having a look at. So again, you could answer all the questions directly online, and there was a question about how much risk you wanted to take, how much return that you wanted, how long you wanted to invest for. So they're all kind of separate questions, and you might be answering them let's say at the far right end, at the most aggressive option. So yes, I want to take, I'm willing to take high risk. I want a really high return, and I'm going to be investing for a very long period. So they always, you'd think that would point you to a high risk investor. But there was another question about inflation. It kind of didn't fit in with the other questions, but it was, are you concerned with inflation? So if you weren't really concerned with inflation, you just wanted a high risk, high return, and you just put low or medium or something like that in for that inflation question, it would kind of skew your results down, and you wouldn't get a high risk result. You would get something slightly less than high risk, even though it was fairly clear that this member is a high risk type of investor. Because they weren't concerned or didn't understand inflation, they might not have answered that question. Yes, I'm really concerned about inflation, and then it would skew the whole risk profiling result. So they got a result less than really what they should have got.
So the mechanics, I guess, have sort of implicitly assumed, the mechanics of how the risk profiling tool is getting to a result have sort of implicitly assumed that if you want a high return, that you must join the dots between I need a high return, and that means I'm going to be concerned about exceeding inflation because that's what a high return will do. If I haven't joined those dots, then again, I've added a bit of noise into the process and I haven't really got what I thought I was getting. Is that what's happening? That's
right, yeah. So, I mean, I think we know it's important to keep up with inflation. And part of our current process, we might even talk to our clients about why it's important to get a return above inflation and keeping your purchasing power, et cetera, et cetera, et cetera. So that might be a reason why you want a high return. But explaining the concept of inflation, we've found is very hard to members, and incorporating it into a risk profile question is also very hard. And when we reflected on it, it's probably might not be the best thing to do. And then when we looked at it, this question, it's just introducing an extra concept that has really got nothing to do with this client's risk profile. And as you said, use the word noise. It's just creating extra noise and extra confusion. And if someone doesn't understand it, then it's going to skew the results.
Yeah. Again, I don't think you're the only ones who've come across this problem, because there's a thing called the money illusion, where people don't tend to incorporate inflation in the way they think through financial choices. There's the problem with compounding relationships. So inflation this year might be okay. It's going to be, prices will be 4.5% higher next year, for example. But in 30 years' time, when I have to start compound over that period of time, people tend to be terrible at that. And even there was an example from President of the US the other day that I did make mention, did note, where he seemed to think that the fact that inflation was falling, so that it's gone from 6 to 4 or some number in the US, I forget what it was. He assumed that meant prices were actually falling rather than actually going up
Just
at a
not
lower.
going up as fast. Yeah.
Yeah. So yeah. So if our case studies come from the White House over in the US or elsewhere, I guess it's diluting the value from the sound of it of the other questions, which might have more validity for the client about what actually is in their needs.
Yeah, that's right. And inflation is a reason why you might need to go for higher returns, but it's not should I be keeping, or do I want to keep up with inflation is not really a good risk profile question we found.
Yeah, no, fair enough.
Yeah.
Okay, so would it be fair then to say that the questions that you've encountered are, I was going to say that, but perhaps it's difficult to write them, isn't it? It's easy to poke holes in a lot of them, but would the conclusion be, well, at least we can improve upon some of them or eliminate the bad ones? Or what was the sort of broad conclusion you drew from all that analysis?
No, well, that's right. It was very easy to, once you started, it was very easy to pick holes in risk profiling questions. That was the easy part. And once you're aware of all these issues, then it's hard not to see them. So, we did have a look at a whole bunch of risk profiles, and we've seen a whole bunch of risk profiling questions. And now I think we had a lot better of an idea what to avoid. So it's not easy to come up with something that's really, really good, but that's what we thought we would do. We'd come up with our own purpose-built risk profiler to take into account some of the latest thinking in relation to risk profiling to try and avoid these mistakes where possible. I think that's the biggest thing. Let's try and avoid what we know is not going to work or what doesn't work. And obviously we approached yourself, Simon, to help out as well with some behavioural finance aspects and thinking in terms of our risk profiling. So that's the approach that we decided to take.
Yeah, I must admit, one of my reflections on it is that whilst there's no perfect risk profiling question or process, you could say, well, we know when we ask clients about risk, there's going to be biases and distortions in the way they think about it if we talk about volatility. And there's going to be biases and distortions if we think about talk about the probability of loss or the quantum of loss, or if we put it in dollar terms. So maybe we can just do it 4 ways and we can start to, I was going to say triangulate, but sort of quadrilaterate the responses so that we've sort of covered our bases and tried to reduce the noise through some sort of averaging of multiple processes that allow you to hone in on the result.
Yeah, no, that's right. Yes, we wanted to try and use simple language and approach it from different angles and try and make it real and bring it back into real terms and real language for someone to understand.
Sure. So perhaps on that note, if you don't mind, if you can give us a quick demo, that'd be fantastic to see where you've landed.
Yes, as I said to you earlier, Simon, we wanted to replace that big long advisor education conversation, which an advisor does manually every single time, with a video that explains things consistently in a manner that hopefully a member can understand. So we want the member to understand the key concepts before they start answering any type of question. So that was just kind of the prelude about before I play this video. This video we're going to make members watch before they can then choose an appropriate risk profile. So I'll play the video for you first.
Thank you.
It's time to choose an investment option. When deciding, ask yourself, how do I feel about risk? How much risk am I willing to take in order to achieve a higher return? All investments carry some risk. One way to measure investment risk is how certain are the investment returns you will receive, and the potential for short-term drops in the amount you have invested. Typically, the bumpier the ride, also known as volatility, the higher the expected return. Higher risk options have the potential for higher returns. That could mean a larger balance for you and subsequently a higher retirement income. However, they're also more vulnerable to market ups and downs. This means you may not be able to protect your savings from losses, especially in the short term. Lower risk options are usually more stable, so you won't have to worry about big rises and falls in your investment quite so much. Their return potential is relatively limited, so depending on the amount of money invested, the risk is your balance may not be high enough to meet your financial needs. it's also important to consider the value of compounding returns. This occurs when positive returns are added to your initial amount. Over time, this compounding effect can significantly increase the value of the investment. Even small differences in your yearly return, when compounded, could make a very large difference to your end balance over long periods. When investing for the long term, it's important to then focus on long-term returns and not short-term ups and downs, which will happen from time to time. It's a trade-off. How much risk are you comfortable with versus how high of a return would you like to achieve? If you're worried about your balance going down in value, especially over short periods, choose a lower risk, lower return portfolio. If you're comfortable with a bumpy short-term ride and willing to take some risk to achieve a higher return, go ahead and choose a higher risk, higher return portfolio. Want to play it somewhat safe but still achieve a reasonable return? Then pick a portfolio somewhere in the middle. There is no right or wrong answer. Select an approach that suits you. The choice is yours.
Okay, so that was the initial video, Simon. I'm not sure if you've got any comments about that.
Yeah, so I just say for anyone listening to the podcast version, I think you've probably picked up most of the content there on the audio. You have just missed a few little icons of charts with arrows and the like. So I think you probably would get the main gist of it. But I mean, my reflections on it, I guess it's picked up a few of the things that you've already mentioned. So you've talked about risk, or the video's talked about risk in a number of different ways. It's talked about compounding returns and the fact that we're going to have over a long period of time that perhaps you're going to get more than you might expect, because if you're thinking about in linear terms, we didn't use that language, of course, but that's sort of, I guess, naturally how people tend to think, then perhaps you're going to underestimate the impact or the benefits of moving off. So I guess you picked up the big ticket issues. It only went for, 2.5 minutes or so, didn't it?
And yeah, we wanted to touch on those key points. I mean, risk was a key one, because what is risk? I mean, there's a lot of, that's the other thing we found with the risk profile questions. They all ask you about risk, but they never actually tell you what risk is. So we wanted to try and explain a little bit about risk, because you talk to a member about risk and they think it's the risk of losing all your money. So we wanted to put that in context, and compounding was the other important one as well, which I'll get to in a little bit more when we actually explain what the risk profiler is. So it takes you to this screen. There is a second optional video that someone can watch. It just tells them how to use the risk profiler. Instead of playing that, maybe I'll just talk you through it if you like, Simon.
Sounds good. Yep.
So when someone comes into the risk profiler, they can the video will explain it. So you can put in your superannuation or portfolio balance, so you make it more relevant to yourself. We've got six different risk profiles. So the underlying end results of those risk profiles haven't changed from what we've always had. Now we've just labelled them A to F. Now we did have a conversation about this, Simon, about what should we call the risk profiles and what should we label them? But we ended up, we didn't want to influence someone by naming certain portfolios, so we've just stuck with A to F. And it starts off down here towards portfolio E, because most default funds tend to have quite a high allocation to growth assets. So this will be similar to where they're starting off with. So again, we had that conversation. Should we be starting off somewhere in the middle? Should we be starting off over in the left-hand side? Where should we be starting? But we're kind of starting it close to where someone's default super fund is. And then for each of the different options, you've got a graph and a table down the below, which I'll go over. And then whatever's highlighted, as you change here, it'll change your expected long-term balance, and each description talks about what your average annual return will be, and how often you can expect a negative return. And then it's kind of these four, I think these are the four kind of key points that people will be looking at. So your average annual return, your compounded return over 15 years, and we wanted to put this in because compounding is so important. And we've got a couple of things on your risk about how often and how deep a risk return would be. So we wanted to balance that out, kind of two positives and two negatives. And if you only look at a 1 year positive return, people might be thinking, well, why should I go for an extra 0.3% return when I've got all this extra risk? But of course, when you compound that over 15 years, then maybe people can realise, oh, okay, well, over 1 year, taking a bit of extra risk doesn't really help me, but over 15 years, it's going to make a really big difference. So that's why we thought not just the 1 year return, but the 15-year return was important to show as well.
Yeah, so this to me is an example of that triangulation we sort of spoke about. So you've got two versions of risk, depending on whether you're talking about the frequency or the size of loss. You've got two versions of return, whether it's annual or compounded. You've also got numbers, which in this case are mostly presented here as percentages, but you've also got the dollars in the chart where you put the actual dollar amount in, and you've got figures, and you've got a graphical representation of the figures as well. So it's effectively, you've just talked about risk and return, but you've done so already in about 6 different ways.
Yes, yeah, that's right. We were trying to hammer, because really that's what it's all about. It's about risk-return trade-off. At the end of the day, that's what your risk profile is. And the table and the graph are linked. So it doesn't matter whether you go here, press C, and as you can see, then C updates here. If you go back here, back to E, the table update. So one thing a little bit different about our risk profiler is it kind of gets you to choose something up front. So we've given you all this information, we've given you a bit of education at the start, then you can play around with it and make your choice. And that's, I suppose, the main part of it. But then after you've made your choice and you're comfortable with your choice, then we want to play back to you some challenge questions. That's what we calling them internally, just to challenge you to make sure that you are making an informed decision and you are comfortable with your choice. Because the other thing what we found is, if markets go down, people come back into us and go, oh, look, I told my advisor I didn't want to take that much risk. I don't know why they put me in this portfolio, and they put a complaint in. I mean, it's obvious why they're complaining, because they're not happy that the market's gone down. But the other reason we think it is because people haven't really kind of owned the risk profiling process. As I said earlier, you get 8 questions and you get a surprise result at the end, and you're told that's your risk profile. Whereas if you're playing around with it, you're much more likely here. We're forcing you to make a choice between risk and return, and you're kind of owning it in a way, and that's why we want to challenge you. So you set something up front, and then we challenge you rather than get to the end and that's your result.
So you've sort of opened the black box and said, no, there's no black box now. You have to make the black box is in your own mind now, I guess.
Yes.
You've got to think about it yourself and come up with your own choice. But you're giving them some challenge or some, I guess, testing their thinking to make sure it hasn't just been a whimsical choice or an error of judgment or something.
That's right. Yes. Yeah. So once they've landed on something, then we ask them to continue, and we ask. We've called them here confirming your choice. So as I said to you, it's kind of their challenge questions, but confirming your choice is what we've called it to the member. And there's generally four questions, unless you're come out of portfolio A or portfolio F. If you're at either extreme, there might only be 2 challenge questions. But what we want to do for anyone in the 4 middle risk profiles is just to ask them some questions to make sure that they are comfortable, that they have thought about it from different angles. And so we'll ask a couple about, do you want to take on a bit of extra risk, or do you, return, or do you want to dial down your risk a little bit more? So the first one is, can you take on more risk to get a better return? And it kind of prompts them to say, a higher balance could provide you with a higher income each year in retirement, allow you to go on more holidays. So have you thought about what really is the purpose of getting a higher return? It's not just a number, but it could mean you're leading a better retirement, going on more holidays, or whatever you want to do in a retirement. So did you want to go for that extra return, or are you comfortable sticking with what you've said up front? So
yeah. And so not only are you sort of, I guess, reframing it in a way that brings that sort of tangible, personally relevant angle to it, but you're also overcoming, to some extent at least, that challenge of comparing this bucket with a thing next to it. In this case, it's the thing next to one above, isn't it? But you can do the same thing on the one down, which I guess that might very well have changed the results for that advisor A or C or whatever it was that you showed us up front, where you had 83% in one bucket. Did they ever get this choice? They never did they?
No, that's right. They never had that direct comparison at the end with the one either side. So if they go no, it would take them back to the front screen, and then they can play around. Obviously, it's prompting them here to have a look at Portfolio F, so that maybe they want to go in and have a little bit more look at Portfolio F and what the risk return trade-off there is, or they can go, no, I am happy with what my choice is. And now we start talking about losses now. So if you haven't not suffered a loss before, you may not realise how this feels. After seeing news headlines or watching your balance fall in value, it's not unusual to feel anxious and to want to switch to a safer investment option. Are you sure you're willing to accept the risk that your balance may reduce by 25% over a 12-month period? In comparison, Portfolio D is only expected to fall by 20%. Now, in this example, it's not a huge difference, 25 to 20. In some of the other examples, it's a lot greater, 20 to 10 and 10 to 0, that type of thing. But again, it's now prompting them to have a look at it. Now, we talked about this when we came up with this question. We're talking about, well, could we use a real life example about the GFC when things were really going terrible? But of course, not everyone lived through the GFC. There were a lot of the younger investors weren't investing at that time. So we just tried to put them in the moment as much as possible, because we know that if markets are falling, it's going to be on the news, it's going to be online, and it's going to be everywhere. So trying to put them in that position.
Yeah, and another point I think you've just made there is that the gaps between your buckets, the A, B, C, D, E, F, they're not all constant gaps, are they? Some are bigger than others. So it might be more meaningful for someone to jump up or down a bucket from A to B, yes, or from B to that sort of thing. Where are the big jumps? Yeah.
The big jumps are moving from the most conservative options. A to B is a big jump because A is pretty much all cash. So even taking on a little bit of risk and a little bit of growth assets makes a huge difference. And B to C is quite a big jump as well. But as you're getting further up the risk return, you're taking on more growth assets. The returns are less, so the additional return is a little bit less. So you're not making as a bigger headway. So it's the biggest jumps are moving from the most conservatives up just a slight notch.
Yeah, okay. So in this case, we've just tested whether they want to go from E to F up, and now we've tested E to D down, and what comes after that. So I've just said, yes, it seems fine. I'm happy that. Move on to question 3.
Yes. So question 3 then is just about how often can you accept these negative returns? And I've talked about risk bands before, which is what all the super funds have to abide by, and that's that they have to measure their portfolios, and this is a big part of how they measure their portfolios, is how often, given their modelling, that they'll expect negative returns. So very relevant to our risk profiling and our results. So we wanted to put something in about, well, every 4 to 5 years you're going to be expecting a negative return, and as we've said here in the question, in the future the economy will have recessions, pandemics, wars and other events that will affect your portfolio. And as the portfolio is linked to the economy, are you comfortable that your portfolio will suffer multiple periods of negative returns where your balance goes backwards? So we wanted to say a negative return doesn't mean just a negative return. Your balance is actually going to go backwards, because some people don't make that connection as well. And as an example, Portfolio D would suffer less years of going backwards. Did you want to look at that one? So again, another one about the risk.
Yeah, and also, as you pointed out, you've also made a connection between this abstract thing of a portfolio going down 20%, which is very easy for me to say, that's fine, that sounds like a great opportunity for me to invest again. But actually, in reality, there'll be a pandemic and we'll all be locked in our houses and you'll be thinking the world's going to end. Would you be happy? So even if I didn't live through the GFC, at least you're trying to put like that there's a narrative associated with this that's going to make you feel like, no, it's a terrible time to invest, and you'll actually maybe feeling like selling rather than maintaining or investing more at that stage.
Absolutely. I remember during the GFC, some people were worried they'd go to the ATM and money wouldn't come out. I mean, everyone, it just sounds funny now, but everyone was just completely panicked, and that and trying to get someone into that mindset is what we're trying to do in these questions.
And no doubt imperfectly, but it's better than nothing, I guess.
Yes. Yep. And so we've had one question about taking on extra risk, and then one question about getting a better return, then 2 questions about risk, and then we come back and ask one final question about are you sure you don't want to go for a bit extra return? So again, just prompting them to have a look at the next one up, Portfolio F. So this one is, looking back in 15 years, would you regret you didn't choose a portfolio with higher returns? You might compare your portfolio to friends' portfolios and think about what you've been able to do with the additional funds in retirement. So again, that was a fairly common scenario where you might compare your portfolio, how it's going to everyone else's. Are you going to have that regret if markets are flying and other people are saying they're getting better returns and going to have more money in retirement? Are you going to regret that if you didn't take on that additional risk?
Yeah, so you brought in the social element here. You've also got the dollars, so that you've converted the dollars so the percentages into dollars to make it more tangible. And the other thing in this one is that it's a reflection. You've sort of asked them to project themselves forward and to reflect back, which then, from the psychology, you end up sort of thinking differently depending on whether you're thinking prospectively or retrospectively. So it's, again, I guess it's another way of asking them to triangulate around a response by sort of thinking about it in different ways.
Yes, that's right. So then we kind of just play back the results. So this is kind of what happens now, but we've just taken a different way to get to it. So you get to the final screen and it's saying, okay, this is your final chance. You're selecting portfolio E, and this is what it means. You're prepared for losses of 15 to 25% on average once every 4 to 5 years. You don't want to go up and take any more risk, and you want a portfolio, and it kind of then just brings it back to a growth defensive mix as well. So it kind of plays back everything to them in a summary, and they've got one final chance to go, okay, you know what, that doesn't sound like me now. I want to go back and retake the whole thing again, which they can, and it just doesn't let them out until they've made that risk and return. When I say it doesn't let them out, of course, there's going to be options to go speak to an advisor, but they can't. They can't finish the risk profile without making that trade-off between risk and return, and then having the final result played back to them and them agreeing that, yep, this one is me. So we're hoping that leads them to owning it a lot more and having less confusion and less complaints when markets, as they will, they'll go down, or they'll go down at some point.
Yeah. I'd love to hear the feedback you've received. I mean, my initial impression of this would be a compliance person would love this. If you ever received a complaint, you just print out all these screens that the client is clicked on, including this one, if they ever lost any money. So keen to hear what sort of feedback you've got from perhaps the legal compliance people, advisors, or any clients that you've tested it with so far.
Yeah, so I think firstly the advisors. Once we've started pointing out all the current issues with the current risk profiling, they're very eager to try something different, and they can see the benefits in this, and they can see the time savings in this, and then they can concentrate on what they do, which is the strategies and putting things into big pictures, help clients setting goals and so forth. So by and large, the advisors are on board. I mean, they've always going to have some kind of feedback about, maybe you can tweak this a little bit here or tweak it a little bit there, or could we have a different kind of graph for when someone's retiring, or whatever the case may be. And there's going to be some good suggestions that hopefully we can incorporate down the track. But by and large, it's been very positive. And the risk and compliance team have been, again, pretty supportive of the whole process and what it's trying to achieve, and how it does take that advisor subjectivity out of it, so it perhaps makes the whole process a little bit easier for them as well.
Yeah, fantastic. So where are you up to then? You've obviously got some feedback. Is it rolling out now in pilot mode? Where are you up to?
We're just about to start the pilot mode. I mean, there's been a few things to iron out before the pilot mode. I mean, we've got a few different scenarios that we wanted to run. We want to run that we want the member to do it maybe in front of an advisor, and we also want the member to do it not with the advisor, so maybe do it before they come in, and then the advisor can just ask, how did you go with that? Have you got any questions, or are you comfortable with where you landed? So maybe having a couple of different approaches to our trial to see if that gives us any different results. We're hoping it doesn't. We're hoping it kind of stands by itself, but it'd be interesting to see that. So we're just starting the trial now.
Fantastic. Okay. Well, I think that's probably we've gone over our 2.5 minutes that we said was ideal for a short video, but with that said, perhaps we can wrap it up now, if you don't mind. But I'm sure people will be interested in getting further information. For those who are, what's the best way to get in touch with you?
Yeah, thanks, Simon. Yeah, so you can reach out to me on LinkedIn. That's probably the easiest way. But also you can contact us at Industry Fund Services, and I'll just, if it's okay, I'll bring up a slide with my contact details. So, and if you wanted to email me, it's at ifsadvice.solutions@ifs.net.au, and our website is ifs.net.au. So you can either send me an email or contact me via LinkedIn.
Fantastic. And similarly, for those who are interested in having a chat to me about some of the sort of behavioural psychological issues associated with risk profiling, I love this stuff. I think it's awesome. Probably LinkedIn's the best way to get in touch with me, Simon Russell, Behavioural Finance Australia. And on that note, I think we'll wrap up. Thank you very much for your time, Craig.
Great. Thanks, Simon. It was great to have a chat.